Hello, everyone, and thanks for joining us for another edition of OIC's Options Educational Webinars. My name is Ed Modla, the Principal of Investor Education at OCC. Here to talk to you today entirely about volatility. That's what this entire session will be about. There should be certainly enough material in here for those of you new to this idea of volatility. We'll define it for you from a few different angles. For those of you who might be a little more seasoned using the options product and have some familiarity with volatility is certainly a lot for you here today as well, as I offer some commentary and insight. And also there'll be a little bit of math in this presentation today. So look forward to all of that. Shouldn't be too complex, shouldn't be over your heads too much, but hopefully something educational for you. First, our disclaimer. And a bit about OIC. We were founded back in 1992 as a free, unbiased source of professional options education. You can find us at optionseducation.org. We have plenty of written material, podcast videos, and past webinars such as these that we have available on our website. Also take advantage of the investor education team. You can send an email to options@theocc.com, and our team will either help guide you to locations on our website that you might be looking for or help answer your options questions. We can do that too. We're not licensed to give guidance or advice, but we can certainly answer questions to the best of your ability or best of our ability. Speaking of questions, feel free to use the Q&A box during this presentation. Send your questions on through. I have fellow OIC educators and instructors behind the scenes today, Mark Benzaquin, Ken Keating. They will be answering your questions live. Of course, many of you are probably familiar with Mark and Ken as they speak during this webinar series as well. So let those questions roll through. The guys will help you out, and I'll bring Ken on board for a bit of live Q&A for the last segment of today's presentation. As I said, it's going to be all about volatility. First of all, defining historical and implied volatility. I'll introduce the Greek known as Vega, and then this concept of historical implied volatility and what that means in effort to take a particular implied volatility level and translate it into something that is useful. It's going to be an awful lot to say as I go through those portions of the presentation. We'll see if there's time for strategies. I can walk through a few of the classic, straightforward volatility strategies. If not, it's there in the PDF for your review. Certainly reach out to us with questions you have about those. We'll see how the timing goes. And if I have time for that segment, we'll walk through it. If not, it's there for your reference. Either way, a lot to get through today. Before we start with historical and implied, I do want to say a few words about broad volatility in general, specifically that it represents fluctuations in stock price without referencing one direction or the other. It could be upside moves, downside moves, really doesn't matter. Volatility is all about fluctuation. Given two stocks that start in the same place, end in the same place, two different volatility levels may exist depending on how those stock price movements occur in between the beginning and ending points. During the observation period, one stock may be more volatile than the other, despite having an open and close that is exactly the same. Also, I'll note that you could have another stock, a third stock maybe that's in here somewhere, moving at a methodical level along with these other two, that might move higher. And as you reach the end of the period, it can be up 3% or 5% or more, starting at the same spot and ending up higher. But volatility does not measure whether or not the stock has changed over a period. It's the fluctuation. This stock here might exhibit less volatility than the other two, even though the other two were unchanged during that period, and this one might be up a certain percentage. Keep in mind, volatility as we walk through it today represents changes and fluctuations in stock price and does not have any reference or guidance towards direction. Well, there's two types of volatility that are going to be dominant today. The first one is historical of volatility. And this is where we're going to start with a definition and an explanation of its relevance. Historical volatility references the stock prices that we have already seen occur in the past. These are observed, quantified, and factual prices that the stock has already displayed. From today, this is looking backwards in time over a certain observation period and calculating how has the fluctuation in prices in this period translated into an annualized volatility level. The investor can choose for themselves what range of time they are most interested in. This could be looking back at the past 10 days of stock price movements, or the past 30 days, or past 90 days, whatever it is you're most interested in using in your analysis. You choose the time frame, and then based on the stock price fluctuations up and down within that time frame, you can then further calculate an annualized volatility percentage. Let's look at an example of 3 different stocks and then talk about what this means for options. In this example here, we have 3 stocks, A, B, and C. They've all got different volatility levels. I'll mostly compare stock A to stock C and see how it looks on the distribution curve. Stock A, with the least amount of volatility observed, we'll say this is over the past 10 days. The historical volatility level that we've seen here, 15%, the lowest of the 3. You would expect then stock A to have the most observations. The number of observations would be the highest near the mean as compared to the other 2 stocks. And the range of stock prices observed in the period would be the most narrow range from bottom to top. Stock C, conversely, has the highest level of observed historical volatility over the past 10 days. This stock would have the lowest number of observations near the mean price and the widest range, bottom to top, of observed stock prices. Now let's think about what this means for options. Options, of course, are going to consider what the stock has done, but more importantly are trying to look forward at what might happen to stock prices between today and expiration day. If this is all the information that we had, stock A has moved at 15%, stock C has moved at 35% over the past 10 days, we're trying to price options that are expiring 10 days from today, we might, or likely would, price options on stock A lower than stock C, expecting that movement to be less. In the real world, we always have more information than just historical volatility. At the top of that list is going to be earnings announcements. Let's say in our example here that stock A has earnings coming out next week, and the stock has consolidated and has been moving very methodically leading up to that announcement. Stock C may have had earnings last week, triggered a lot of movement in the stock price, and now it's starting to settle in to a lower level. Given that information, we certainly and more likely would price options on stock A higher than stock C because we know what's upcoming. Historical volatility has its place, it's relevant, and is part of the conversation, but I'm going to stress that it is just part. There are other factors to consider. A little more, you might be thinking, if there is earnings on stock A, how would I price the option? Past volatility, the historical volatility, is not a good representation of what's going to happen after earnings. And this is where some familiarity with the stock may come in. Market professionals particularly might have an advantage here because they can look back or possibly have the experience of knowing, based on previous earnings announcements, what kind of reaction did we get out of the stock? What kind of volatility was observed after previous earnings announcements, and then incorporate that into their decision on how and where to set volatility moving forward. This also means that more mature companies that have been trading for many years might have better markets, meaning tighter bid-ask spreads as market participants are more comfortable with what to expect, in contrast to a company that maybe just IPO'd and is coming out with their very first earnings announcement. The market doesn't know what to expect there. They're not sure what volatility should be, and those are the circumstances where oftentimes you see wider bid-ask spreads, fewer market participants placing their bids and offers because there's uncertainty. I've mentioned looking forward and this volatility level that the market is expecting to see, and that is going to take us to our next topic. Implied volatility exists only in options, and it is, by definition, the volatility assumption which justifies a particular option price. It's forward-looking between today and expiration date. It can be calculated and determined using an options pricing model. There are variables that you need to insert when you're going to calculate a theoretical options price. The stock price, strike price, days to expiration, a volatility assumption, along with interest rates and dividends, if any. When inserting all of those variables, you can calculate using an options calculator a theoretical options price. We've got one on our website. If you want to do this, you can certainly find our options calculator and investigate. You can, if you can't find it, certainly reach out to our team. Again, that's options@theocc.com. Send us an email. They'll help guide you to it. But in addition to calculating the option price, you can also observe the option price. This is what you're seeing trading in the open market, or the midpoint of the bid-ask, or maybe the price you just traded this option at. If you know the option price, you can work backwards. Input the stock price, the strike price, days to expiration. Leave volatility unknown. Input interest rates, dividends, if any, and input the option price. Back solving for the volatility level, the volatility assumption where that option is priced given a certain premium level in the option. Our calculator on the OIC website also allows you to do that, and it certainly is a good, valuable educational exercise. There are mathematics there, but also keep in mind, regardless of pricing models, regardless of the calculation, the implied volatility is going to be the result of market forces, supply and demand. Everybody who is entering bids and offers, that's you, that's me, that's every advisor, money manager, institution who is placing bids and offers and moving option prices higher and lower, is ultimately the driver of who determines options prices. Calculated values are theoretical. They are hypothetical, but they are overridden by supply and demand in the marketplace, which comes from everybody. As I said, with historical volatility, it's looking backwards to compare the two, backwards looking at the time frame of your choosing, to witness what has the stock done and what volatility level does that represent. Implied volatility is forward looking, and as I described it, being calculated with the pricing models, one of those inputs was the strike price. So it does follow that each strike price will have its own volatility level. And one of the things you can do or observe is plotting those levels. If you have implied volatility on a vertical axis and you have the strike price on the horizontal axis, you can plot where each volatility level is across strike prices and then connect the dots. And if you did that for your traditional, most common underlines, particularly index underlines, you would get this classic looking volatility skew or volatility curve, where the lowest strike prices have the highest levels of implied volatility. There's a bottoming out, the lowest point here just above at the money, and kind of a tapering off. And this is largely because For many underlyings, and again, particularly index products, put options, cheap put options, are used as protection against portfolios. And market participants, money managers, are often very willing to pay for cheap put options for that very purpose, to protect their portfolios if there are lower and lower in strike prices here that are driving prices higher because of that demand for portfolio protection. That leaves you with higher implied vol levels. And that's your classic looking volatility skew. But for each individual underlying, it certainly doesn't have to look that way. You can have other underlyings that have skews that are more symmetrical between the upside and the downside. You can have other underlyings that have inverted skews and may have higher volatility levels for calls than puts. The more symmetrical ones, traditionally and typically, this might be found in, say, commodity markets, where the speed that the underlying might move higher or lower is about the same. So you get this more flatter and more symmetrical look. Inverted curves, you would expect to find these in products that have an inverse relationship to the direction of the overall market. As the market moves lower or the market corrects, any products that increase in value might see this inverted curve. With respect to equities, you can see all of the above as possibilities. Normally, you have this traditional curve, but each individual equity can take on a life of its own. Certainly in the recent market activity within the past year, the call buying that I have observed has been more frequent than perhaps I've ever seen in the market before, and there have been plenty of examples of inverted curves in underlyings, equity underlyings, because there's a lot of demand to buy calls, driving prices higher. There's not as much demand to buy puts, driving prices lower. So you really can't think of implied volatility as synonymous with supply and demand, those dynamic forces that are always changing prices. Implied volatility, of course, can be at great variance with what the stock has done. We've outlined that for a variety of reasons. The past levels of stock price movements may not be a good representation of what we expect to see moving forward. And another thing to always remember about implied volatility is you can expect it to change constantly. As supply and demand is always changing, bids and offers and market dynamics are fluctuating throughout the day, every day. Implied volatility levels are going to change. They will change intraday, throughout the day. And they do not require changes in the stock price or a fundamental change in where the stock price has been moving or what we've observed. All it takes is a change in the dynamics between buyers and sellers or the supply versus demand of particular options. That is going to be the driving force that will change implied volatility. We'll start to get into a bit of the discussion on what do you do with volatility? How is this relevant for options users? First of all, you have to start asking questions. When you observe an implied volatility level, will it return to the underlying stock's historical level if there is some kind of variation? Will that happen? Of course, that's not necessarily true. For a variety of reasons, the stock may set a new course for how the volatility in its share price will look moving forward. There might be a new normal set for the fluctuation in stock prices. It's not safe or it's not assumed that volatility levels are going to merge and gravitate towards the long-term historical volatility level. Of course, you do have to be very aware of implied volatility. And again, I want to emphasize another way to think about why be concerned about implied volatility. You can also substitute and say, why be concerned about the forces of supply and demand? This is going to affect the value of the options trades that you have. If you buy a particular option, Of course, you want more buyers to come into the market for your option or similar options. If that happens, even if the stock price doesn't change, you would expect the value of your option to be influenced higher and possibly be in a profitable position just because the demand increased for the option you just purchased. And conversely, if you buy an option, nothing else changes, stock doesn't move, but all of a sudden there are large sell orders that are entered into the options market for the same option you traded or for very similar options, that could drive prices lower. That could scare away some of the bids and lower the price of the option. That would leave you in a losing position just because the dynamics of supply and demand have changed. Now, this price movement and the forces that I'm describing, the dynamic forces of supply and demand, are explained and highlighted through the mathematical computation of implied volatility. Now, let's look at the effect on prices. Again, it might be intuitive to interpret that everything remaining constant, as implied volatility increases, then the expected range of prices from top to bottom, from today until expiration date, would widen. The potential prices on the upside and the downside both increase. Higher prices are possible, lower prices are possible, and therefore both call and put prices would increase. As implied volatility decreases, then the potential range of future stock prices will shrink, become more narrow, and that would lower both call and put prices. Also, you might be wondering, when volatility does change, how can you estimate what kind of effect that might have on your options contract? And we'll get to that in a couple of slides. But where is volatility the greatest? Where is it going to be the least? With respect to strike price, changes in implied volatility will be more significant. Options will be more sensitive that are at the money. Your strike prices close to where the stock is trading are going to be more sensitive. And that makes sense. If you have the volatility increase by 1%, that's not going to have too much of an effect on options that are far deep out of the money or far in the money. Not going to change those values a whole lot. But for your at-the-money options, any change in implied volatility certainly would have an effect. So at-the-money options have greater sensitivity to volatility changes. What about expiration? Well, through the more intuitive explanation, if you change implied volatility by 1%, and there's only 1 day left until expiration, that's not going to have too much of an effect on the perceived range of future stock prices. There's only 1 day left. That's not going to change very much. But if you have 12 months left until expiration and you increase volatility by 1% over that entire 12-month period, that will certainly have an effect on the range of potential prices and increase options. So there you have the strike price and expiration date. Again, to summarize, volatility changes are more sensitive for at-the-money options and longer-term options. Now we're going to get into the numbers of what kind of change might we expect when volatility changes, when volatility moves higher or lower. What's that going to mean for the option? But let's just refresh and take a look at what does the actual number mean. And I'm not going to go through too much of the math. Don't want to confuse you. But here we have an example just to highlight what is this implied volatility number referencing. And then I'll also translate this into something else that might be more useful for you, called the rule of 16. I'll define that in just a second. But here we have XYZ trading at $80, and you have the options trading at 30% implied volatility. Now, I said earlier that each strike price has its own implied volatility level. That's true. You can also average those levels. You might see that a particular expiration date is trading at a certain implied volatility level. Usually what that means is there's an average taken of calls and puts and then calculated into one singular number to identify implied volatility for a certain expiration date. So here you have 30% is the implied vol level. And what that means is that 30% represents a one standard deviation move from the current stock price. Current price is 80. A 30% move is $24. Now, for those of you familiar with what one standard deviation means, as we look at it in the chart, one standard deviation means that about 68% of the time you would expect the observed stock prices to be within the range. If you double that to two standard deviations, you would expect 95% of the observations to be within that widened or doubled range, just taking 30% on either side and then doubling the move from 24 to 48. You might notice very quickly that these are fairly wide ranges. Some investors might look at these volatility levels, calculate a standard deviation, and try to let it help them determine a strike price. That's one way you can use this analysis. But again, it does leave you with fairly wide ranges. That's what the number means. Now let's talk about what the rule of 16 is. And this is a bit of shorthand that some traders from the trading floor might use just to interpret volatility in a different way. A little bit of math here. I started as a math major in college. I didn't finish that way for a reason, so I'm not going to get too much into the math. But I'll start out by saying volatility is a function of the square root of time and not time itself. There are 252 trading days in a year. If you take the square root of that, the result is approximately 16. What this means is if implied volatility is 16%, then that number is suggesting that the average daily move in the stock is going to be 1% every day between today and expiration date. You take the implied vol level and divide it by 16. In other words, if implied volatility is 32%, 32 divided by 16 is 2. That suggests that the average daily stock price change from today until expiration date is going to be 2%. You might use this number to then form an opinion. It might be useful to take that implied vol, divide it by 16, and then think, well, that's the average daily move that this level is suggesting. What do I think about that? Is that high? Is that low? And that could help you possibly lean towards buy or sell strategies. I'll just emphasize that the rule of 16, of course, is going to result in an average daily move. Keep that in mind. 2% or 3% might sound like a big number, but you could have far more observations less than that with just a few higher than that to reach that average. Also, it's common for investors to ask me, should I be selling options I deem as expensive? Should I be buying options that I think are cheap? That is a common question, certainly one that'll help drive trading decisions. And the short answer would seem to be yes. If you think an option is expensive, lean towards selling it. But I always caution options users, when something is expensive, do your due diligence and look at reasons why that's the case. Something that's expensive can certainly get more expensive. Something that is cheap can get cheaper. So keep that in mind as things might be higher or lower, might deviate from the average or the mean. It doesn't mean or doesn't necessarily follow that they're going to revert right away. I said earlier, there's a way to take an implied vol level and start to investigate if this vol level changes. What's that going to mean for my options price? This is Vega, the volatility Greek, specifically the option value's sensitivity to changes in volatility levels. With a 1% point change in implied volatility, Vega will express in decimal monetary form how much you would expect the option price itself to change, all else equal. It represents the cash amount per option. As I said before, greatest for at-the-money options and long-term options. The reason why Vega can have such a dramatic influence on option prices is because, recall here, it's 1% point change. When implied vol changes, or again, when supply and demand, when the forces and the direction of supply and demand change, they can be at much greater intervals than this small 1%. And this is where using a calculator can, again, be a wonderful educational exercise. And I encourage you to do it through our website and the calculator that we have. Changing implied volatility levels by 5%, 10%, 15%, moving them higher, moving them lower, and seeing what kind of effect that is going to have on options prices. It's also a good exercise if you're trying to understand, why did the option I bought or sold change in price the way it did? Because on the surface, it doesn't seem to make sense. I know where the stock went. I know how long it took to get there. I expected this option to be trading at a different level. With that question, undoubtedly, the answer is implied volatility changed, the supply and demand forces changed, and it had an effect on your option premium. Now, we did just that when we put this presentation together. So a few examples of looking at some numbers just to get a sense of how these prices could change. First, we'll do a call option example. Say you bought a stock XYZ, 50 strike call for $3. You've got a few months until expiration, and you notice that the stock moves around quite a bit, but it's right back where it started. It's unchanged. Or perhaps you weren't looking at this stock, and you just check and see, well, it hasn't changed at all. Nothing happened. Nothing's going on. My option is probably suffering some time decay, but with no stock price change, I'm sure I'm not making any money. And then you check your platform and you see the price is now up to $3.40. Well, logically, because the stock didn't move higher, some time may have passed. You might be surprised by this. But what has happened? The implied volatility has increased. In other words, the demand for your 50 call has increased for some reason. Maybe there's news that has now been put on the calendar that wasn't there before. Maybe there's been an announcement by this company that has changed the potential for future stock price movements. Maybe something's happened in its industry. For whatever reason, more demand has come in for these options, driving prices higher. Since we're driving the option prices higher, implied volatility is going along with it, and it has moved. It has gone up from 35% up to 40%, and you have an unrealized profit with a stock that has not gone anywhere. Again, implied volatility is often observed in its most significant fashion before and after earnings. So just briefly about that dynamic. Leading up to earnings announcements, it's common to recognize implied volatilities drifting higher. That doesn't necessarily mean the price of the option has gone higher. What it means is that demand might be holding steady. The price of the option might be exactly the same from one day to the next, even though time is passing. And when you have less and less days till expiration, but you have an option price that is not decaying at all, the result is going to be implied volatility moving up. Oftentimes before expiration, that is what you see as buyers hold their bids and sellers are less aggressive. And then after earnings, once the announcement is made, the information is known, the potential for future movements is a lot less. That is when you tend to see implied volatility levels get what we say crushed, and option prices decrease. Let's take a look at a put option example. Here will just be a little more straightforward. Stock price at 60, put option, strike price is 59, got a month left until expiration. Let's just change the volatility level and see what that does to this put premium. If we insert 20%, we can calculate a theoretical option value of $1. And we would expect at this level of volatility, the bid and offer to be centered right around that premium. If volatility was higher, 30%, the premium we would expect is a theoretical value for the option about $1.80. If we increase it even further, up to 50%, you can see the dramatic effect that these changes in implied volatility have on the option premium. And these kind of changes, 10%, 20%, they can happen if there are large unexpected moves, or if news hits the market that was unexpected. You can get these dramatic shifts in implied volatility from one day to the next or 1 week to the next, all the while keeping in mind that even if you're not seeing large moves, implied vol is changing constantly throughout the day as the stock moves, as days pass, and as those forces of supply and demand continue to evolve. Now that's quite a bit there on historical volatility, implied volatility as separate items. Now I want to take another step into how you might take implied volatility and translate it into something useful. And I'm going to call this historical implied volatility. As I define this, I want to make it clear. When I use the word historical, I am not at all referring to what the stock has done in the past. This is directly historical levels of implied volatility. That's what this is going to be all about. By tracking implied vol over time, an investor can get a sense for where the current level is compared to the historic levels of itself. Today's implied vol level versus past levels of implied level. And they can make sense of that. They can compare the current level of implied vol and how it relates, not just to what the stock has done, but more directly to recent or past levels of implied volatility itself. This is comparing apples to apples. Where is today's implied volatility? Where was implied volatility yesterday? Where was it last week? Where was it last month? That's a direct comparison. Professionals who are trading the markets and doing a volatility analysis are often doing just this. They are not necessarily comparing historic volatility, those stock price movements, to implied vol levels. Instead, they are comparing implied to itself, determining if the current level is higher or lower than previous levels, and then from there, asking a key question. If it's higher or lower, what's the reason? Will it revert back to the mean? Is there an earnings announcement? Is there something else going on? That second component is very important. If implied vol looks too high today, what does that mean? What do you do with it? Is there a good reason? Might it continue to move higher? Or do you form the opinion that it's about to retreat back towards its historical mean? Now, this can potentially seem like a very intensive analysis. You need a lot of data. You need a lot of numbers. And that's true. However, there are a few metrics that can be helpful that your trading platform might make available to you. And as options trading gets more and more popular, I would expect more platforms to look for ways to include these types of analytics. I'm going to define IVOL rank and IVOL percentile as two of the more popular analytics that you might come across. Both of these are doing that apples to apples comparison of today's implied vol level to some historic data set of past implied vol levels. Starting with eyeball rank. Eyeball rank compares the current level of implied vol to a range over a defined time frame. There's only 3 observations that are used when computing eyeball rank. It's the range of, say, the low level, the high level of the range, and then the current level. So for an example, we have, we'll say the time frame is usually 1 year. The lowest level of implied volatility over the past year, 20%. The highest level, 60%. Today's level is 40. These are the only 3 observations that eyeball rank is going to consider. And then with 40 being exactly in between 20 and 60, the eyeball rank would be 50%, right in between. If 40% started to drop and move closer to 20, then the eyeball rank is going to drop somewhere below 50. If 40% starts to move higher, closer to 60, then the rank is going to move up. If you did get to 20, then the eyeball rank would be 0. And that's what we want to highlight there, just to further clarify the definition. An eyeball rank of 0 means the current level is the lowest of the year. A current level of 20% instead of 40 would leave an eyeball rank of 0. 100% means the current level is the highest of the year. Current eyeball was 60%. It's the highest. Eyeball rank would be 100%. The clear limitation of eyeball rank is just these 3 observations. It's certainly useful. It has information that you might find valuable. But the one anomaly is where you run into, say, a deficiency with eyeball rank. If there's a short, quick spike up to 60%, the eyeball rank is not going to include that in its calculation or analysis. It's just going to take the 3 numbers, the 3 observations, 20, 60, 40, and then give you a number. Eyeball percentile does something a bit different. It does include all of those observations, and it is the percentage of days that implied volatility has been lower than the current level. If you see an eyeball percentile of 60%, that means previous levels of implied vol have been below the current level 60% of the time. This includes all of the observations within the time frame. To compare these two, again, the hypothetical circumstance of, say, a stock that has implied vol at 20% all year long, it never changes, then some rumor comes out, and for one day, volatility spikes up to 60%. The next day, that rumor is false. It goes right back down to 20, and it sits there for the rest of the year. If today's level was 40%, the rank would still be 50. The percentile would be very different, including all of those observations. The percentile would be, we'll say, roughly 99%. The previous levels of vol have been below the current level almost the entire time, with the exception of that anomaly or that quick move higher. And you do tend to see that, particularly in years where there's a sharp, quick correction. Saw that in 2020 when the market corrected and implied vols did shoot much higher and then eventually come back down and settle down. You saw a lot of those eyeball ranks a bit skewed because they had a high number. This high-end range was not necessarily representative of the majority of the time where vol was. And so that put the eyeball rank a bit different. It would actually yield it a bit lower because you have that high number. So that's just one thing to consider. Two different volatility analytics. They mean different things. Many investors that I run across, they use both. They look at both and determine what value they want to place or what relevance they want to place on each of these metrics. I'm going to walk through strategies rather quickly. I do want to bring Ken in here for some Q&A in just a couple of minutes. So I won't spend too much time here on strategies. You certainly can reference the PDF, ask us questions. But just a few words as I walk through this. The classic volatility strategies. First of all, that starts with the straddle. You can buy or sell a straddle. But we'll focus here on the buy side first with the stock trading 87.5. You have the at-the-money call, at-the-money put. The straddle is either buying both or selling both. In our example here, we're buying the straddle, paying for the call, paying for the put, and you have this total net debit. Now, the reason why this is a pure volatility play is because it doesn't matter which direction the stock goes. The buyer of this straddle at expiration would need the stock to be at 91.50 for this call option at 87.5 to be worth $4. That pays us back the net debit we paid up front. On the put side, we need that 87.5 put to be worth $4 to pay us back. That's at 83.5. There's your break-even point. Outside of that range, the straddle buyer is profitable. So this is volatility. It doesn't matter which direction it goes. We just want it to move an awful lot. Now, of course, the straddle buyer doesn't have to just wait for expiration and hope there's a big move one way or the other. Now, often the straddle buyer is monitoring the market and might get out at some point. If there's a sharp move higher up to, say, the mid-90s, they might sell their call option and hold the put for a move lower. True volatility, of course, might mean that you have moves in either or both directions. So the straddle buyer will interpret what their objective is, but they might hold the straddle till expiration, or they might get out in pieces, one at a time, depending on what they think the market is going to do. And then another pure volatility strategy, sort of a cousin of the straddle, is the strangle. This, again, is either buying or selling both options, a call and a put, but the strangle breaks up the strike prices. Instead of buying both at-the-money options, the strangle buyer goes out of the money for the call, out of the money for the put. They pay less, which means their maximum loss is reduced. And in exchange for that lower cost and lower total potential loss, they'll have wider break-even point. They will need a larger move in order to be profitable. And of course, their maximum loss is going to be in between the strikes. With the straddle, maximum loss is only when the stock gets pinned to your at-the-money strike. With the strangle, you have this range of maximum potential loss here in between the call and put inner strikes, a wider break-even range, and for those for that concession, you have a lower cost and lower potential loss. You might hear straddles and strangles referenced if you've heard, say, economists or market analysts. When an earnings event is upcoming, they may say to you the options market is expecting or predicting a certain percentage move in the stock price. And I'll toggle back a slide because most often it's the straddle that's used in this way, specifically for a binary event, a specific event. They might say, well, the options market is pricing in X percent of a move following this earnings announcement. If the earnings is on Thursday afternoon and the options expire one day later on Friday, just look at this example. If the stock was at 87.50 and the at-the-money straddle was trading for $4, well, that is suggesting about a 4.5% move. $4 divided by 87.5. The options market is expecting about a $4 move in the stock as a result of that binary event. If you ever heard economists mention that percentage number coming from the options market, that is likely what they're referring to. I'm going to bring Ken on here in a second. Just want to remind everyone, please check out our website, optionseducation.org. All the education that we have, our OCC learning, which is always changing and evolving, new material that we like to put up there. We have coursework tailored to specific learning styles, experience levels, and of course, different topics, our podcasts and videos, and then reach out to the team. We have a lot of videos on our YouTube channel, so check that out. And our team can be reached by email at options@vocc.com. So hopefully you found all that useful. And before we encourage you to take that survey that's going to be attached to this presentation, Ken, if you have your audio up and running, let's bring you on board and see what kind of questions the audience has been throwing our way.
Thank you, Ed. Thank you for that presentation. We've been getting a lot of really good questions. So I think the presentation was very well received. And let's just get into a couple of them. So I know you probably mentioned earlier about volatility charts, but one of the more frequent questions is where does one find historical volatility figures for stocks or ETFs? And if you go to our website, you go to optionseducation.org. On the website, if you go to the menu and you search under the options quotes and tools section on our website, that's actually options quotes and calculators, section on our website. We have a whole list of tools that you can access, and third from the top is a historical and implied volatility chart. Now, this is only a one-year chart, but it's free, and you can put in any symbol, stock, ETF, and you can look at the historical versus the 30-day implied and how they moved over the last year. A lot of traders will look at more granular data. Now, if you're looking for more granular data, if you want longer dated charts, shorter dated charts, you would have to reach out to a third-party provider. Now, we at the OIC can't endorse anyone in particular, but if you go to the Options Price Reporting Authority's website, and that's Opera Plan, OPRAPLAN, operaplan.com, they have a Find a Vendor tab on the homepage where you can look at all the third-party providers and the services they offer. So speaking of volatility, and I'll pass this over to Ed, and some of the other questions is what are some of the volatility timeframes that you like to use? I kind of know what I used to use when I was a trader, so maybe Ed, you can talk about what are the timeframes that you like to use. I know there's no real right or wrong answer for this, but somebody was asking about what time are good to look at.
Sure, and you're right, Ken. There's different ways to answer it. Each investor may decide, what they're interested in looking at, what time frame is most important to them. I'd mentioned a few of them. Maybe you're looking at 10-day, 30-day, 90-day. I'll answer it this way. Most often when I speak to investors, they're looking at a 30-day volatility of the stock. To get a sense of what's been going on. Certainly I'd also say that your expected days to expiration, your duration to expiration may play a role in how much data do you really want, very short term or very long term. So there are, as you said, Ken, different ways to answer it. But I'll just say most often 30 days tends to encompass enough data to be a relevant number and well-used number that sort of encompasses a little bit of both short-term, long-term. That intermediate time frame of 30 days is the one I hear most about.
And I know personally, I mentioned that we have a one-year volatility chart on our website. As a trader, I often would look at 2-year charts, sometimes 1-year charts, sometimes 5-year charts. Because if you're in a period where the volatility is extreme, you really want to kind of see where volatility reverts to, or the average volatility over a long time period. So sometimes maybe a yearly chart isn't enough. 1999, perfect example, when all the internet stocks were going crazy, everything was really elevated. Earlier this year when coronavirus hit, volatility very elevated. So sometimes you want to look at a more broad picture of volatility to see where it's been, where it could go, the range, both short-term and long-term. So,
and the last thing there, Ken, as you mentioned that, if you are coming up on an earnings announcement and you want to get a sense of what has this stock done in the past with earnings, That's generally going to be a longer-term look, and a lot of investors will say they're looking back about 3 years, if possible, to get a good representation of what the stock has done during prior earnings announcements. Certainly different time frames are possible, but it'll be up to each investor to decide.
Right. And this actually gets to another really good question. Somebody asked, in the case of implied volatility being elevated or really high, is it guaranteed to mean correct? And I guess I would answer that as, it's the old adage that, the market can sometimes stay irrational longer than you can stay liquid. So just because the volatility is high doesn't necessarily mean it can't stay high for an extended period of time. Now, in theory, over time, yes, volatility is somewhat mean reverting. So when volatility is high, it should go lower. When volatility is low, it should go higher. But there's certainly no guarantees in the market in terms of volatility. So anything you'd like to add to that?
Yeah, whether you're looking at IVOL rank or percentile or some other metric, and you've determined, say, implied vol is high compared to where it's been, I have heard many times investors say, well, it's a mean reverting measure, and I don't disagree with that. But the tougher question, as you're suggesting, Ken, is it going to revert? But we're talking options here. You do have to choose an expiration date. When is that going to happen? So you do have to ask those follow-up questions. Is there a good reason why it's high or possibly too low? When might it revert? And does that actually yield a trade or not? There's going to be undoubtedly some level of uncertainty. If option prices were indeed too high, then everyone would be selling them, and that would correct itself pretty quickly. So usually there's some reason why volatility levels are elevated, and you just would have to discover that and then form an opinion.
Great. Another question we got is, when trading options, which is the more important factor to consider, delta, theta, or Vega? I guess I would answer it that they're all important. I think, we did a presentation on the Greeks last month. If you're not aware of the Greeks, you should certainly check out that presentation. It had a lot of really good information. The Greeks are sort of your dashboard of how your option position is behaving. As Ed mentioned in the presentation, volatility, I personally feel that volatility is the most misunderstood, the crucial aspect of trading options, only for the pure fact that volatility can change by 5%, 10%, 50%. It can change depending on some of the crazy stocks that we've seen this year. Volatility has just been parabolic. So it's one of those factors that can change so much more than some of the other Greeks. And not to discount the other Greeks, they're all important, but volatility, if you can't figure out why you're making or losing money on a particular options position, generally you can point to implied volatility changing as the reason why. So I don't know, anything you want to add to that, Ed?
That's exactly right. It's really hard to choose one of the Greeks and say this is the one that's most important that you have to pay attention to. But yes, the one that can have the most unpredictable effect on your option price is going to be Vega, because of those changes in implied volatility potentially being extreme. As Ken mentioned, over the past year, some of the changes in implied volatility, we saw levels get well into the hundreds of percent implied volatility for some underlyings. The changes can be so large. And again, that's supply and demand. That's the effect of many option buyers coming into the market and few option sellers, and that drives volatility levels dramatically. So it really is hard to isolate one. If the question had included gamma as one of the choices, when I teach Greeks, I don't say gamma is the most important, but arguably has the most information in it. But the Greek conversation is one for another day. With respect to delta, Vega, theta, Vega is the one that really can be hard to predict, but they're all important.
Right, and actually, there's somebody else along the same line. Somebody actually asked another question. I've seen cases where the price of the underlying stock decreases, but associated call option prices increase. Is this purely due to volatility? And I would answer that, yes, this is the case. There are times when volatility will, typically when stocks go down, volatility goes up. And there are instances where even though the stock's going down, the call prices might actually go up in value. So this is one of those situations where, you can't figure out stock's going down, you're long calls, but you're making money. This might be one of those situations because the implied volatility is actually going through the roof, and it's actually increasing the value of those calls. Similarly, on the downside, there's something called skew, and I know Ed talked about this. Before 1987, option prices didn't really have skew, and when we had the crash of 87, traders really woke up to the idea that stocks go down quicker than they go up. So they started pricing in the downside to a higher level in terms of implied volatility than the upside. So the downside options are always going to be a little more elevated, at least in general for stocks and indexes, than the upside. And anything else you want to add to that, Ed?
Yeah, Ken, one of the ways I explain that effect on prices is to say that the direction of the stock price movement has an influence on options prices. The stock price moving lower will have a negative effect on the call option price. The changes in days to expiration will have a negative effect. The decrease of changes in days to expiration will also have a negative effect on the option price. But volatility might have a negative or positive effect. You don't know. And in the example with the question, clearly there is an increase in demand for options for whatever reason that might be. That's driven volatility levels higher. So while the stock moving lower and maybe days passing influence the call option price lower, the impact of volatility, specifically the impact of Vega, had a greater effect than those other two, and you end up with a higher option price. That can certainly happen. And as Ken was saying, when you're confused about what price you're seeing based on the stock price changes you've witnessed, undoubtedly that's because of changes in implied volatility, which are triggered by changes in the forces of supply and demand by all market participants.
Great. That's a really great answer, Ed. I'm going to hand it back to you. I think we're out of time now, but I know there's probably a few more questions that have come in. Just to let you know that if any of your questions did not get answered, somebody on our investor services team will reach out to you in the next 24 hours and answer your question. All questions do get answered. And I'm going to hand it back to Ed, but thank you for attending today's presentation.
Yeah, thanks, Ken. Great questions, great participation. I hope everyone found it valuable. And as Ken mentioned, you can review the PDF. You can send us an email. All of the questions and comments that you sent through, we'll take a look through those and get responses out to you. And if you haven't done already, please take the survey attached to this presentation and let us know what you thought about the presentation, the topic, and what you learned here today. We look at every comment and every response that we get. Helps us make decisions moving forward on how to select the topics and evolve the program in the future. So thanks again for your time and attention today, and we hope to see you at our session next month.